folks. I'm going to try and go through this chart deck as fast as I can this morning. First off, both our technical and valuation models suggest that a bottom has yet to be found. In fact, I have reason to believe, and both models confirm this, that the bottom won't be found until we reach this area. I would say 2030 to 2086, possibly just below 2000. But for now, I'm going to bet on the 50% retracement of the rally from 2009 till February 2020, and I'll explain why in a minute. So, what we got so far, okay, the correction has so far unfolded as a wave A, followed by a wave B, a 50% retracement of wave A, and since then, wave C has been underway, okay? Delving into the details of wave C, I've identified wave 1, I've identified wave 2, wave 3, and then wave 4. Now, of course, and I have to remind you that I wrote an article saying phase 1 complete when we hit this bottom right here. Why? Because that rally from 2 Fridays ago, that long green bar, was accompanied by a 90% up volume day. So you knew there was evidence of institutional buying. We haven't had a 90% up volume day since late December 2018. So these guys aren't trying to time the bottom. They know that there's enough pain out there to warrant nibbling at stocks, price discovery, in other words. But we came in on last Monday on a down note, of course. We had this down day, and then the rest of the week was simply range bound, okay? Range bound. Now, of course, today we're down here somewhere, and we are approaching exactly what the wave structure has been suggesting. And, using the Fibonacci projections for wave 5, and I'm not going to use those in a vacuum, of course. Using the Fibonacci projections, a typical wave 5 would reach 2086 to 1976. We have a Tom DeMark line right high, a support line right here, TDST, Tom DeMark support trend at about 1991. But we also have, may I remind you, the 50% retracement of the bull market, 2009, 2020 bull market, 50% retracement at 2030. I'm going to stick with that as a high probability bottom. Now, our valuation model, I spoke about the technicals. Now I'm going to talk about valuations. And most people are trying to value the S&P as a multiple of forward earnings. Forget forward earnings. We have an earnings recession now. We cannot rely on what the forward earnings estimates were prior to this pandemic. Okay, this is like a black swan here. Nobody counted on that, but I warned about it several times in February. So instead of relying on forward earnings, you rely on 2019 earnings or 4-quarter trailing earnings, the trailing 4-quarter earnings. What has happened in 2019 that we know happened? We're not going to estimate what's going to happen because we're not going to have growth. Now we're going to have a recession. So if you try to price the S&P in terms of the trailing 4-quarter earnings and you try to put a multiple on it, we're down to that orange line right here, which is 16, actually 16 and some change, if you notice right here, about 1630. In a typical bear market, okay, in a typical bear market, what you get is a 15 or a 14 multiple, and that puts us right about here, okay, which is what our technical analysis is suggesting. So the two models, the technical and the valuation models, are in agreement as to where the bottom will likely occur. All right, now listen, I also said that to every action there's a reaction. We were sorely overbought right here. We were trading at a 25, almost 24 to 25 multiple. And historically, this has been an extremely overvalued situation, leading to a severe correction. We had it in 2018 and we had it prior to that as well. Okay? So valuation and technicals both agree. Now, let's look at another valuation chart, and this is what I'm talking about. Again, using the same valuation model that I designed, and looking back at history, we know that in 2016, the S&P reached lofty valuations. It was overvalued by 22% or more. Okay, don't tell me how I'm building this graph. That's how my model that I designed works. When the S&P is deemed overvalued, and you might have 10 people coming up on CNBC, one is telling you that the market has a lot more to go, it's fairly valued. Another guy would come to you and tell you, it's still undervalued, it's reasonably valued. Another guy will show up, or gal, and tell you, no, it's way too overvalued right here. Well, I do believe that, based on my model, it was very overvalued in 2016 and 2017, and again in 2018. Okay? As you can tell right here. In fact, we got to almost 25% overvaluation in 2018. But what happens then the market reverts to the mean. That's fair value, the black line. This is where the market is fairly valued by, but markets rarely ever are just fairly valued. They either overshoot to the upside or they overshoot to the downside. So by the end of December 2018, the market was almost 12% undervalued based on my model, leading up to a V-shaped recovery. But the cycle, the vicious cycle, continues. You go from overvalued to undervalued and back to overvalued. And right here, they couldn't have enough. They didn't know where to stop. We got back to an overvaluation situation, and the coronavirus was the catalyst that led to the cord to snap, okay? Led the cord to snap. And you guys know where we are right now. So if you look at this chart right here as of last Friday, we are 18% undervalued. In other words, now listen, we are in the middle of a pandemic. The economy is at a standstill due to social distancing. But you never know when a bit of good news will turn things on a dime. So we went from 22% overvalued to 18% undervalued, and I expect this to reach 22 to 24% undervaluation before the good news starts rolling in. Less infections, lower death rate, medication working, vaccine on the way, so on and so forth. You know what I'm talking about. And, believe it or not, and I'll show that in a minute, markets always snap back ahead of the economic recovery. They lead the economic recovery. I did a very thorough homework this weekend, and I'm going to talk about it in a minute, but I spoke about the technical model. I spoke about the valuation model. This is our buy-sell model. Our buy-sell model has yet to fire or trigger a buy signal. We don't have one yet. The blue line, it's still above the orange line. And look at how timely the signals have been over the course of, say, the last 8 to 9 months. And I can go back and, back test the model to show you that it's pretty darn timely. And it works in conjunction with both the technical and the valuation model. It's not used in isolation of the other two. So June 4th, we got a buy signal. July 30th, we got a sell signal. October 9th, we got a buy signal. And February 21st, we got a sell signal. All right, and again, this is not used in isolation. The three models, technical, valuation, and buy-sell models, they work together to, of course, identify buy and sell opportunities. This is our model. We start here. We consult with the technical analysis model. What's the consensus, bearish or bullish? If it's bearish, we go to the valuation model. And is the market overvalued? If it's not, we move to the sidelines. If the market is fairly valued or overvalued, and maybe it's time for some sort of a pullback or maybe even a major correction like we're seeing now, we resort to the buy signal, the technical buy-sell signal, to trigger us into a short trade. Conversely, if the technical model is signaling, say, clear sailing, okay, it's saying, hey, I'm seeing calm waters ahead, meaning there are some bullish prospects to consider. Then we go to the valuation model. Is the market overvalued? And if the answer is no, we also rely on the buy-sell signal to trigger us into a buy or a long trade. So it's all mechanical. Now, going back to the S&P for a minute, all right? I already said this is A, wave A, and then we got the wave B. That's when the Fed intervened the first time with that panic stimulus, or they lowered the rates. What did they lower them by the first time around? 50 or a full dollar or something, and then they came around the next time and lowered them to 0 to 25 basis points. But that was the reaction to the first Fed intervention. And then wave C got underway. Wave 1, wave 2. Notice that waves 1 and waves 3, they subdivide into 3 waves. Okay, I'm using the harmonic Elliott wave model, not the classic model here. And those who observe the market closely know that moves nowadays are all happening in 3 waves. 1, 2, 3. And I've been wondering why this has been happening a lot, and now I'm attributing it to algorithmic trading. They have all these things programmed. If I get a rally followed by a partial counter reaction, I'm going to get a third rally. Okay, that's how computer programs or algorithms function, as well as all these traders, hordes of traders that are playing ABC patterns. But and there's also another reason, that is Dow theory, and I'm gonna defer that discussion to a later time. I'm not gonna talk about it right here. But anyways, wave A. I originally, when I said phase one complete, I felt that wave A ended here. I said, you know what, maybe this harmonic Elliott wave model isn't working. Maybe this is 1, 2, 3, 4, and 5. And I did that with a grain of salt, to be honest with you. Okay, and then we had that rally 2 Fridays ago. What happened when we came in on Monday? Boom, it told me that, Peter, you should have put your faith in what you normally do. So I put wave 3 here, then we had a sideways wave 4, followed by wave A, wave B into Thursday, last Thursday. Now here at this point, and I'm going to label these again, wave A, B, and C, of course. Now I felt that, when I saw this right here, I said, could this be C? And then I looked at it and it doesn't subdivide into zigzags. But you know what happened here? What happened right here at this level, wave C achieved a size of 161.8% times the size of wave A, meaning wave C equal 161.8% wave A right here. So you knew that technical folks were fishing for a bottom. And so, and everything was proceeding fine. Wave A, wave B, which is great. So now I'm expecting wave C. We come into Friday morning and the market is up 3 to 4%. I said, could I be wrong? Again, I didn't trust what I was saying. Could I be wrong? I looked at it and I saw that the futures did this during the overnight session. All this stuff. But really what the futures were doing is they were pulling a misdirection act on us ahead of quad witching Friday. In other words, wave your hand in one direction and then do something else later on. But, despite this move in the overnight session, when the cash session opened, and by the way, when I almost changed my mind, just to let you know that when I saw this move, I started doubting myself. So I said, you know what? Maybe wave 3 ended here. Maybe that rally 2 Fridays ago was wave 4. And maybe the Wednesday low, or whenever that occurred, Tuesday, Wednesday, was wave 5. Maybe we did indeed completed that ABC at the 161.8% relationship. Okay? So I didn't have much faith. I should have had more faith. And of course, I justified it with the momentum pattern, which, by the way, this is going to hold. Okay? We're now in wave 5. So all this red you're seeing here, since this started right here, all this stuff right here is wave 5. Okay? And wave 5, basically, it occurs on higher momentum. It starts to create bullish divergences. Okay, so we're now in a wave 5 phase, during which you'll notice that your momentum indicator is tracing out a series of higher lows. And you don't have to go to the momentum indicator. Look at the VIX. Okay, we are at new lows, yet the VIX is nowhere near where it was when we printed lows here in this area, when it hit 70 something, if I recall, or 80 something. I'm not sure exactly what the VIX was at. Or look at VXX, which reached into the 70s. Yet today, even though the SPY or the ES is trading at new lows, it's still in the 60s. So you know that we are running out of sellers. The panic is slowly subsiding. So this was wrong, what I published on Friday morning. And believe it or not, this right here is still valid. In fact, even though we came into Friday morning thinking that the futures are going to rally, when the cash session actually opened, the SPY never invalidated this prior high. That was still the high that we saw on Thursday. Okay? Even though the futures did this a little bit, they came down here during the Thursday overnight session, and they rallied a bit into Friday morning. But when the cash session opened, the SPY and the SPX, the S&P cash, did not make a new recovery high. So again, the forecast is still in play, and we're looking for that area between 2009 and 209, 203, which roughly corresponds to the same 2030, 2086 on the S&P 500. Okay, the homework that I did this weekend. I pieced a lot of these things together. Now, the S&P 500 was incepted in 1957, if I'm correct. And so, how could I possibly go as far back as 1871? This is information that precedes the S&P 500. Some of it came from a well-known economist by the name of Coles, actually. I believe it's, trying to remember his name, I think it was Alfred Coles. Alfred Coles had stock data dating back to the 1870s. But prior to the S&P 500, there was another index, and that index, among other indices that Standard & Poor's had created, is the S&P 90. Those were bellwethers for the economy back then, and you can, piece them all together to create holistic pictures of where stocks were back then and where they are now. So I was able to identify wave one, which ended in 1973, leading to a wave two due to a recession. That recession lasted, a year and a half or so, during which peak unemployment reached 9%, GDP took a 3.2% hit. So we had a 50% decline, which is what we're seeing right now, right? We're seeing a 50% decline. No, we're not. We're at like 30-some%, okay? 30-some%. And then from wave two, remember, even though the recession ended in 1975, the stocks, they bottomed in October 1974, well ahead of the end of the recession, meaning they're leading the economic recovery. And so we went on for several years, 15 years or so. We got this next recession, and that next recession in 1990, 1991, it took a 1.4% hit on GDP. Peak unemployment reached 7.8%, but it wasn't much of a drop. Okay, it wasn't much of a drop. What do you think this red bar right here is? That red bar was the 1987 crash. And by the way, there was no recession back then. It was blamed on computer trading, lack of liquidity, derivatives trading, that kind of stuff. Okay, so now once the recession came to an end, again here, stocks bottomed in October 1990 ahead of the end of the recession. In other words, the recession ended March 1991. Look when stocks actually bottomed. And then what happened then? We all know what happened. We had an breathtaking explosion up to 2000. That was a third wave. That's what third waves do. They just explode, an exponential move. And that's to understate it, okay? 3, 4, 5, we had another recession, not just a recession, but we had the burst of the dot-com bubble, where we had a boatload of companies going public and they had barely any revenues, if any at all, okay? So what happened then, we had the crash into October 2002. Fed intervenes. They stimulate the markets and the economy with monetary policy. We rally back up to a barely new high compared to this one. So we had a double top situation, but everybody thought that we had it up to new highs, but then we got another situation here, another recession beginning, the housing bubble. The housing bubble led to another crash that took out that wave A temporarily. It was, anything below the 50% retracement of wave 1, blue wave 1, was utterly rejected. So it was an interim or a brief situation, a rejection. Let's call it rejection. Wave C, below wave A, everything, or below the 50% retracement, was utterly rejected. This was a textbook ABC flat. This is what we call a sideways move, ABC. So wave 2 retraced roughly 50% of wave 1 that began how long ago? 125 some years ago. Okay? Interesting, isn't it? Now, what happened since? You're going to be blown away here when you see the next chart, because we have wave 1, wave 2, and then we broke above the 1500 and change a few years back. I don't know when did it happen. 2013, I believe, is when it happened, or 2012, 2013. We finally got above this double top right here. And that signaled what? The start of wave 3. Okay? So when we broke above this line or this zone right here, this told us that wave 3 is underway. Now, as of February 19th, when the stock market topped, wave 3 was at a textbook 176.4% the size of wave 1. Isn't that amazing that something that began in the 1870s, which we deemed to be wave 1, and something that happened 11, 12 years ago, which we deemed to be wave 2, led to a rally whose size is a beautiful Fibonacci multiple of wave 1. So if this is truly wave 1, this is wave 2, and this is wave 3, where are we at right now? We are in wave 4 mode. Okay. Now, something to, some food for thought here. Wave 2 was an expanded flat. It's a complex pattern, the expanded flat. In other words, sideways, A, B, C. Okay, I should use yellow here, but that's fine. So ABC is an expanded flat. And the Elliott wave theory tells us that if wave 2 is a sideways move, wave 4 should be a sharp move down. That's called the principle of alternation. And that's exactly what we're getting here. A sharp move down to what I believe should be wave 4, not to exceed the 50% retracement. Could it go a little lower? Yes, there's room for that. But I think it's probably going to stop right here. And remember, we were having limit down days, one after the other, 5%, followed by another 5%. And now we're getting 1.5, 2.5 down days on lower VIX. We're making lower lows on lower VIX. What does that tell you? We're approaching some sort of bottom. Not to mention that as we close in on the end of the month, we're going to see, no matter what, especially on good news, some end of quarter window dressing. Let's see if it holds in this terrible environment, whether this, this thesis holds in this horrible environment. We'll see. Are they going to buy stock into the end of the month, yes or no? So this is my thesis. 1, 2, generational wave 1, 2, and a generational wave 3 leading up to or ushering in a generational wave 4. What does that mean? Are we going to move back up in V-shaped? Anything is possible. Okay, anything is possible. I personally doubt it. If we get down here, okay, and this is prognostication. All of it is, actually, but at least it's educated prognostication. We get down here and we say stage an end of quarter rally. This would probably be a counter trend rally wave X, but I believe the low would have already been in. So at some later stage, we're going to retest those lows, and then we probably trace out some sort of triangle right here. In other words, similar to what happened last summer, 2019. Remember, we had the initial low in early August, and then we had several retests that didn't quite reach that low, but we ended up with a triangle from where the next rally began. In other words, the market found its rhythm and then began to rally in early October into February. Something very similar would happen here. By then, wave 4 would have ended at a higher low, even though the nominal low is here at 2030. We're going to have sideways action for months to come, and then wave 5 will begin. How far up? Don't ask me at this point. I'll rely on the valuation model and the technical analysis model to tell me where wave 5 will ultimately come to an end. Now, here's something I wanted to show you, the alternation guideline for the Elliott wave theory. It says the guideline of alternation states that if wave 2 of an impulse of a rally, because we had a 5-way rally, we call that an impulse. The 5-way rally, 2009 to 2020, by definition is an impulse because it unfolded in 5 waves. So if wave 2 of an impulse is a sharp retracement, accept wave 4 to be sideways. This is scenario number 1. And vice versa, meaning if wave 2 is sideways, you see that sideways move right here? That's wave 2. That's wave 2 right here. Wave 4 is sharp. This is scenario number 2. And this is exactly what we have. Okay? Wave 2 is sideways. Wave 4 is sharp. Let me go back in case you don't remember. Okay, here we go. Wave 2 is sideways and wave 4 is sharp. That's exactly the situation we have right here. All right, so cool. The analysis is conforming to what the theory says, but again, textbook stuff and real life stuff sometimes diverge, and we have to keep an open mind. At least for now, things are unfolding according to the theory. And no theory, by the way, is infallible. No technical analysis is infallible. The markets are going to do what the markets are going to do. They're not going to pause and ask me for permission to do what they want to do. Nasdaq began trading, or was launched in 1985. The dot-com bubble was wave one. Okay, the bubble burst or popped, wave two. Believe it or not, first waves are always disbelieved. And that's what happened then, afterwards. The disbelief led to the crash. What's so interesting about the Nasdaq, by the way, is that at the bottom, or at the height of the financial crisis, when the S&P actually came back and retested and briefly breached the early 2000 lows. In other words, the S&P was down here, if you recall, and then it rose back to the highs and came back down slightly below the early 2000s low. That was the sideways move that we called an expanded flat. The TEX, the Nasdaq 100, didn't follow the same pattern as the S&P. Okay, what happened then is it had a tepid rally into 2007, 2008, and then when it came down with the rest of the market during the financial crisis, it actually retraced 78.6% of the rally. So the bull market for the Nasdaq didn't begin in 2009. It actually began here, late 2002, when stocks bottomed. Okay, so that was wave one, wave two, and what we saw emanate from the wreckage of the financial crisis that was actually late 2008 for the Nasdaq is a breathtaking third wave. Okay, breathtaking third wave. So wave one, wave three just ended, and now we are in wave four mode. At least that's what I believe, and hopefully we'll see whether this turns out to be correct or not. We'll find out sooner or later. So again, sharp move down, and I expect months, several months, maybe over a year of sideways action before this economy recovers. We're going to be range bound for a long time, in my opinion. All those guys betting on a sharp recovery and V-shaped recovery and all that, I don't know about all that. But what I can tell you, though, is I do expect, given what's happened recently, I do expect some sort of sharp rally into the summer ahead of the elections. They certainly do want the stock market to recover quite a bit of what it's lost, whether they use the plunge protection team or the Wall Street proponents who want to keep the administration in place. They want to see it have a second term. They'll probably help the cause by rallying the market towards, maybe I'm not going to say up to here, somewhere, 50% or something, 61.8%, and then move sideways. And then we'll see what happens after the election is over. Right? So it's going to be, if you think those are interesting times, let's see what happens between now and November 2nd. It's going to be even more more interesting in my opinion. All right, so that's the Nasdaq. Now, the SOX index. Look, if my analysis comes true, the S&P reaches 2,000. Do you think it can possibly double? Yes. The technical, if we hit here, the textbook objective for wave 5 would be in the 4,000s, 4,200, 4,600, something like that. Same thing with the Nasdaq. It gets down to 6,500 or so. The technical objective for wave 5 and yellow wave 3 is 12 to 13,000. So these two indices are going to double. Do I believe this? Yes. Because the SOX index, the SOX semiconductors, which are the lifeblood of the modern economy, they've traced out a cup and handle over the course of how long? Okay? Cup, handle. Now, if you turned off the news completely, you didn't know what was going on in the world, you see this breakout, okay? You see this from the handle, we broke out. 5-wave move completed. 1, 2, 3, 4, and 5. Now you know that once a 5 move has come to an end, you're going to have a correction testing the lows of wave 4. And in essence, this is a back test of the breakout area. This is the breakout area right here, roughly speaking. And this is exactly where we are right now. The correction is unfolding as an ABC, aiming for this pink zone, more towards the bottom of wave 4. I don't know what the SMH is trading at this morning, but I bet it's closer to the 4th wave, the end point of wave 4, than it was last week. Okay? So again, turn off the news. You don't know what's going on. Look at it from a purely technical perspective. This is simply a retest of the 4th wave on the heels of a 5-wave run, and chart pattern lovers, fans, would deem this as a back test ahead of further upside. How much upside? Well, this cup and handle has a textbook technical objective of 2,600. Okay, so we get down to 1,200 or so, this thing is going to double. And you know that the SOX have been outperforming the S&P 500 by leaps and bounds. In other words, I said that over the years, the last 5 years. I told you at the bottom, the 2015-2016 correction, that the SOX is going to double. It more than doubled. And then again, at the bottom of the 2018 correction, I said it's going to double again, and certainly did. So once again, for the 3rd time, I'm going to go out on a limb and say that this thing is going to double again once this correction is over. All right. Transports. 1, 2, 3, 4, 5. And now we're getting what? We're getting a correction back to the bottom of wave 4. A little less, a little more. We'll find out how much, in the vicinity of the endpoint or the terminus of wave 4. Okay, now we had a Dow theory non-confirmation during the 2019-2020 rally. Transports, they topped right here, okay? In 2018, I believe it's October 2018, they topped. And then they came down, crashing with the rest of the market into late December 2018. And then the S&P, the SOX, the Nasdaq, they all went on to make new highs even though the transports failed to do the same. What does that tell you? When the transports failed to confirm the rally in the broad indices, Dow Jones, Nasdaq, S&P, and the SOX, it tells you something isn't right. In fact, we've had a similar situation right here. 2014, that was October 2014, when the transports topped and they began to decline as the S&P was rising to new highs in 2015 along with the Nasdaq. Okay, the transports were not confirming what the other indices were doing. So what happened right here, right about here, when the S&P and the Nasdaq and the SOX, they finally reached a top, the cord finally snapped and they all came down, crashing into 2016. Okay, 2015, 2016 is when the correction ended. And then what happened after that is once the other indices, the broad indices, finally completed their corrections with the final phase in the transport traced out an inverse head and shoulders continuation, and when it broke out above the neckline, everything fell into place. We had an exhilarating rally 2017, 2018, and then the rest, 2018 top, similar to the 2014 top. Indices rally unbeknownst or, contrary to what was being seen in the transports. Dow theory non-confirmation. We didn't have a confirmation, and that led to the cord snapping in 2020. All right, so anyone who thinks that Dow theory is out of style is out of their minds. Nasdaq Bank Index, same exact thing, along with the Russell 2000, by the way. You had the top in 2018, all the indices corrected together, and then 2020 high, well below the 2018 high. So again, financials aren't confirming either, not just the transports. And then boom, this is what you saw. Now, I'm going to use the banking index as a guide here in the next couple of days because we have a technical pattern, a head and shoulders, whose move indicates an ABC ending at the 78.6% retracement, right where wave C equals 161.8% wave A. This is a typical correction. Okay, and look at the model here. This is the textbook model for an Elliott wave. 1, 2, 3, 4, 5, followed by ABC. What do we have here? 1, 2, 3, 4, 5, followed by an A, B, and a C. If the C wave, where's the C wave shown? Well, and by the way, I just noticed this, head and shoulders. Same exact thing. Now we have a downsloping neckline. What does that mean? When you have a downsloping neckline, it means that you measure the downside from the right armpit, not from where it breaks the neckline. And so that's where we're getting right now, a C wave that's about to end. And look, until something changes, there's no point, seriously, to listen. There's no point to listen to bubble theorists and crash theorists and depression theorists and all that. Okay? All right. Russell 2000, same exact situation. You had the top in 2018, followed by what? Non-confirmation, lower high, and then an A and a B and a C down to the area of the fourth wave, maybe a little lower today, but let me tell you, it actually behaved fairly well last week. It didn't go crazy like it was doing earlier. It held up above. It held above the terminus for the endpoint, or the fourth wave endpoint here. It's right about here. I think it's gonna bottom. Maybe a little lower. I don't know. We'll see when the market opens. All right. So again, situation 1, 2, 3, 4, 5. The bear market for the Russell, for the bank index, the Nasdaq bank index, and for the Dow Transport. The bear market began in late 2018. All right, that's important to note because all these corrections, they do the same thing over and over again. But hubris and irrational exuberance and whatever you want to call it, they distract the mind and they keep people from really seeing the true picture. All right, and we can tell right now you have a lot of investment shops going out of business. Dow Jones Industrial Average, same thing. Wave 1, 2, 3, 4, 5. Sharp correction. And it filled that gap last week like I predicted it would. And in my opinion, it'll probably bottom right about here. 50% retracement of the 2009-2020 bull market. At the same time, it will backtest the top of the broadening formation. Okay, in other words, right here, think of this line as the breakout line. 50% will put us in the low 18,000s. I hope to see this happen very soon. And, and we'll take it a step at a time, of course. We'll see what comes after that. Next chart. This is worrisome, but I'm sure a lot of stimulus packages, fiscal, monetary, what have you. This is more, both fiscal and monetary. What this chart tells you is that corporate bonds, the price of corporate bonds is crashing. What does that tell you about corporate yield? It's rising astronomically too. What does that mean? It means it's really difficult for companies to borrow money in the markets, because if they sell their bonds, they'll have to pay a hefty yield. In this current environment, that's almost impossible, and that's what the SHYG or the HYG is basically telling you. So, but all these stimulus packages they're working on, they also are targeting not just families and individuals and average Americans, but also small businesses, and they want to keep the economy functioning and make sure that once this coronavirus is in the rearview mirror, that this economy can snap back in a reasonable fashion. They don't want to create irreparable damage. They want to cause irreparable damage, and that's what all these stimulus packages are for. Whether you agree with it or not, we'll see how it goes. All right, so that's pretty much all I got. I hope I covered everything for you, and I'm looking forward to the opening bell at 9:30. Anyways, have a great day and remain vigilant, please, in this tough environment.